guys. You're listening to Real Estate the Ramsey Way. This episode is all about making smart decisions with your mortgage, and while it's the only kind of debt that I'm okay with, I'm not okay.
Did you know that buying a home is one of life's most significant investments? Your home is much more than just a place to live. It's a cornerstone of your financial future. Today, we're here to explore the best way to finance a home and avoid mortgage traps with the wisdom of financial guru Dave Ramsey.
Mortgage interest rates being super high right now, and we showed a stat there.
Join us for an enlightening journey that will empower you to make informed decisions about your home investment. The buzz about mortgage rates has been hard to ignore, with fluctuations making headlines. Let's dive into the crux of this matter. In the opening statement, we touched upon the rollercoaster ride of mortgage interest rates. To fully grasp the significance, we need to understand the dynamics behind these rates. Mortgage interest rates are the lifeblood of the housing market. They determine how much you'll pay for your home over the long term. In January of 2022, the rates were around a modest 3%, but by May of the same year, they had soared to a whopping 10%. It's a staggering rise that sent ripples throughout the real estate world. This wild roller coaster of rates has led many prospective home buyers to explore an intriguing option: adjustable rate mortgages, ARMs. It might sound like a tempting opportunity, especially when fixed mortgage rates seem to be climbing faster than Everest. However, this is where the first trap is laid, and it's essential to navigate it wisely. ARMs, in essence, allow your mortgage interest rate to change as market rates fluctuate. It may appear to be a smart move when rates are high, but is it a gamble worth taking? Let's break down the traps that can come with ARMs. Why are ARMs suddenly back in the limelight after a decade of relative obscurity? Well, there are a couple of factors at play. One significant factor is a sharp increase in home prices. As the housing market thaws out from a year of suppressed demand, more potential sellers are listing their homes. So, ARMs are being offered as a means to entice prospective buyers, especially those looking to get their foot in the door of their first home. But here's where it gets tricky. While it may sound like a golden opportunity, there's more beneath the surface. We need to consider the motivations of entities like credit bureaus, specifically Experian, in promoting ARMs. Their interest in this matter isn't entirely altruistic. They stand to make money when you secure a mortgage, and they must assess your credit score. The question arises, is it your financial well-being that they're truly concerned about, or is it their bottom line? Now let's delve into the intriguing world of statistics to unveil the evolution of adjustable rate mortgages, ARMs, and the changing landscape of the mortgage market. The percentage game here is more than just numbers. It's a window into a shifting trend that prompts us to ask why ARMs are making a comeback and what this means for prospective home buyers. Not too long ago, ARMs represented a mere 3% of the mortgage market. In simpler terms, only 3% of new mortgages were of the adjustable rate variety. What's truly captivating is how these numbers has transformed over time. By October, that 3% had catapulted to a significant 13%. This is a seismic shift in the mortgage landscape, indicating a substantial increase in the adoption of ARMs. But the story doesn't end there. As of April 2023, this figure had settled to around 8%, showcasing a slightly decreasing yet still noble presence of ARMs in the market. The statistics therefore beg us to seek answers to the question of why ARMs are becoming increasingly prevalent. Are there underlying factors driving this resurgence, or are prospective home buyers embracing ARMs without fully grasping the potential risks and implications? To understand this phenomenon more comprehensively, we need to explore the motivations and circumstances surrounding ARMs' resurgence in the context of today's ever-changing financial landscape. Now that we've established that ARMs are making a comeback, it's crucial to delve into the inner workings of these financial instruments. Adjustable rate mortgages, ARMs, can be a complex puzzle, and understanding how they function is essential for making informed decisions in the realm of home financing. An ARM's interest rate is a key component that sets it apart from traditional fixed-rate mortgages. It's determined by two primary factors, an index and a spread. To illustrate this, let's consider a hypothetical scenario. Imagine you sign up for a 4% ARM with a 2% spread. This means that your initial interest rate starts at 6%, 4% plus 2%. So far, this may appear relatively straightforward, but the devil is in the details, specifically the index. The index is a fundamental element in the ARM equation. It's important to recognize that this index is far from a fixed constant. It's a dynamic entity that fluctuates in response to changes in market conditions. The crucial distinction here is that when you sign your ARM, you're not locking in a specific interest rate as you would with a fixed-rate mortgage. Instead, your interest rate is tethered to the movement of the index. This index can vary due to an array of economic factors, including, but not limited, to changes in the Federal Reserve's policy, economic growth or recession, and fluctuations in the bond market. It's the unpredictable nature of these factors that forms the foundation of the ARM's inherent gamble. To grasp the potential implications of the index variability, consider a scenario. You decide to take an RM where the index stands at a modest 2%. In conjunction with your 2% spread, this brings a total interest rate to a manageable 4%, 2 plus 2%. This initial rate might seem appealing, especially if they're lower than the prevailing fixed rates. However, the plot thickens as time progresses. The index isn't stagnant, it's in constant flux. What happens when your ARM is due for an adjustment? If the index has moved, let's say to 2.6%, your interest rate will rise in tandem. This occurs even if the broader market's rates remain stable or exhibit a slight decline. In essence, your interest rate becomes unshackled from the predictable course of market rates and instead becomes subject to the whims of the index. This peculiarity is at the heart of the ARM's predictability and the risk it carries for borrowers. It's akin to rolling the dice on your financial future, and the outcomes are far from guaranteed. To appreciate the origin of ARMs, let's take a quick back to the early 1980s. Back then, interest rates are used as strumpical heights, with a staggering 17% interest rate being far from unusual. This created a dilemma for banks. While they had millions of dollars of mortgages on their books at fixed rates, they were paying a higher interest rate to attract new savings deposits. The situation known as dissemination put banks in a tough spot. So, in an attempt to protect themselves from this financial conundrum, the adjustable rate mortgage was born. It allowed banks to transfer some of the risk in interest rates to various borrowers. It was a pragmatic move for banks to safeguard their interests, even if it meant borrowers were exposed to more significant financial risks. In essence, ARMs transfer the risk of increasing interest rates from the lender to the borrower. When the interest rates go up, so does your mortgage payment. The bank ensures that it makes money irrespective of market conditions, effectively securing the financial well-being. This is a stark contrast to what you might have believed, that ARMs are designed to be a blessing for prospective homeowners. In reality, it's not about helping people get their foot in the door of home ownership. It's more about banks looking out for their interests and ensuring they don't end up on the losing side of the market. In conclusion, adjustable rate mortgages may seem enticing when you first hear about them, especially in a climate of rapidly increasing fixed mortgage rates. However, as we've delved into the intricacies of ARMs, it's become evident that they come with a series of traps and financial risks. With a fixed rate mortgage, you have a steady and predictable monthly payment. You know exactly what you're doing, into a budget accordingly. On the other hand, ARMs introduce uncertainty into your financial life that often lead to financial disaster. To all potential homeowners out there, our message is clear. Be cautious and well informed when it comes to mortgage financing. Don't be lured by the siren call of adjustable rate mortgages. They often come promised more than they can deliver and could potentially jeopardize your financial well-being. Your home is one of the most significant investments you'll ever make, and it's essential to make informed choices that will protect your financial stability. Stay clear of the mortgage traps and remember that your financial future is what truly matters. Thank you for joining us on this enlightening journey through the world of home financing and adjustable rate mortgages. We hope this in-depth exploration has provided you with the knowledge and insights you need to make informed decisions when it comes to your own home financing. If you found this video helpful, make sure to hit that like, subscribe button and for more engaging content.